Welcome to Ahead of the Curve from K33 Research. Today is June 16th, 2026. A written version of today's analysis is available at k33.com/research. Bitcoin has finally caught a break. After 2 weeks of heavy selling, the market is showing the first signs of stabilization. ETF outflows have slowed materially. Long-term holders remain remarkably inactive. And the derivatives market still looks cautious rather than overheated. That doesn't mean the correction is over. But it does suggest that some of the forces that pushed Bitcoin lower are beginning to fade. The biggest change over the past week has been in ETF flows. Between early May and early June, Bitcoin exchange-traded products saw close to 100,000 Bitcoin leave the market. That created a steady source of selling pressure and was one of the main reasons Bitcoin struggled. Over the past week, those outflows slowed sharply. Demand is not exactly rushing back into the market, but the selling pressure is no longer accelerating. Markets often stabilize before they recover, and that's what we're starting to see here. At the same time, trading activity has fallen significantly. Spot volumes are back near the lowest levels of the year. Normally, falling volume would be a concern. But in the current environment, it tells a slightly different story. Investors who wanted to reduce exposure have largely done so already. Existing holders appear reluctant to sell at these levels, while new buyers remain cautious. The result is a market with very little urgency in either direction. It may not be exciting, but it is a healthier backdrop than the persistent selling we saw a few weeks ago. The most encouraging development is coming from long-term holders. During the rally in 2024 and early 2025, older Bitcoin was constantly being reactivated and sold into strength. That pattern has almost disappeared. Very little older supply has moved this year, despite the correction. At the same time, nearly 79% of Bitcoin's circulating supply is now held by long-term holders, the highest share ever recorded. That tells us that the investors with the strongest conviction are staying put. Historically, that has often been an important ingredient when Bitcoin moves from a period of weakness into a more constructive phase. You see a similar pattern in derivatives. Activity remains subdued across both institutional and offshore markets. CME, a key venue for institutional Bitcoin trading, has seen some improvement in open interest, but participation remains well below previous highs. Funding rates have turned negative again, and futures premiums remain low. In other words, traders are still cautious. The market is not positioned for a major rally, but it is also not carrying the kind of leverage that tends to create violent liquidations. For now, the derivatives market looks defensive rather than fragile. The next major test comes from the US Federal Reserve. This week's Federal Open Market Committee meeting will be the first chaired by Kevin Warsh. Markets broadly expect interest rates to remain unchanged. The bigger question is whether Warsh signals a meaningful shift in policy going forward. Bitcoin's correlation with the S&P 500 has increased significantly in recent months, which means macroeconomic developments are having a larger impact on crypto than usual. Investors will be watching not only the rate decision itself, but also the Federal Reserve's updated economic projections and any clues about the path ahead. Right now, those signals may matter more than anything happening within crypto markets themselves. The overall picture is becoming more balanced. ETF selling has eased. Long-term holders remain committed. Derivatives positioning is cautious but orderly. None of that guarantees that Bitcoin has found its bottom. But the market looks healthier today than it did a few weeks ago, and that is an important change. To summarize, Bitcoin is showing early signs of stabilization as selling pressure fades, long-term holders remain firmly committed, and derivatives markets stay defensive, while the next major catalyst is likely to come from the Federal Reserve rather than from within the crypto market itself. Thank you for listening to Ahead of the Curve from K33 Research. Subscribe for future market updates and visit k33.com/research to read the full report and explore our latest research.